What's your name and what do you do?
Hello, I'm Ivan and I do finance.
Amazing. I got a couple questions for you.
Of course, mate. Sure.
What does your day-to-day actually looks like? Because from the outside of finance, looks like suits and Bloomberg terminals. What's the real version?
Well, I guess a lot of people think of financial industry as a very glamorous thing. You know, these finance guys dressed nicely in a shirt and quarter zip, like this one from BELLUMAIRE.
Yeah.
I just walking in London and just doing maximizing shareholder value, just doing some analysis, obviously using some of the software like Bloomberg. But in reality, it's not as bright. Obviously, you have to spend long hours doing some financial analysis, and obviously it is very competitive. So it is quite hard for just a person to start as a financial analyst and then sort of grind towards the higher sort of higher goals. So obviously you're not gonna be doing any decision making at first. So you're gonna be just an intern walking and doing some financial analysis, doing some useless and stupid work. But this is how it is. So you have to start small, right? Easy, and then you gradually increase your level of competence, and you increase your level of decision making. Yeah, so it is very stressful and very hard to work in finance, despite the belief about glamorous life of financial people. Although what I can say about this industry is that I have met a lot of pretentious people in finance. Like, I started as a corporate finance guy, right? And then I moved to financial analysis, and now I'm more into, private equity sort of thing, asset management, because I do it personally. I do IB, investment banking as well. But I started as a corporate finance. And there are other industries such as consulting or management in finance as well. And those people think they are financial guys as well, but they're not. So obviously a lot of pretentious people, a lot of people who have no clue about what they do.
They're not in the mud.
They're not in the market at all. They not in the high tier finance. I am, so I'm looking into that. Although I've met a lot of people who are very pretentious, and that's I mean that's quite a large thing for financial industry, especially people who sell something online, like all of these financial gurus who sell different courses. Although some of them are useful for understanding, but those who sell you the mispricings, or different signals, or trade buy signals, so you have to take action off, right? That's very fraudulent, because if they're going to sell you, if they're going to just give you an information about market mispricing that they found, it wouldn't make any sense for them, because in accordance to the efficient market hypothesis, we all know about it, in its strongest form, it says that the markets are perfectly efficient. Although it's not attainable in the real life, but we have this assumption of different mispricings in the market. And actual insiders who know about these mispricings would never tell you about them, because they're taking advantage of it themselves. So that they would never sell it to you. So all of the financial content online for different trading and stuff like that, it's fraudulent. It's not true. So do not purchase it. Do not pay money to these people.
Yeah. You might get scammed.
Yeah, I know, yeah.
Anyways, moving to the next one. A little bit easier. So, what's your perfect Saturday?
Saturday is my favorite day of the week, actually.
Is it?
Well, I guess it is definitely not in London. I can tell you that much. Well, I guess somewhere warmer. Somewhere in the northern west part of Italy. Somewhere close to Rio Maggiore or Portofino. That's what I like. So wake up early in the morning, drive my yellow cabrio to a tennis court, play some tennis with whoever, doesn't really matter. Then, get some marvelous breakfast, and then just, appreciate and romanticize my life. Because you need to understand that life is not only about success and, walking and just corporation. Sometimes I have to take a break. And I would love to wake up in northern Italy one day on Saturday and just do nothing at all for one day,
Yeah.
just to recharge, jump back in on Monday, fully refreshed, fully invigorated, back to corporate life in London.
Yeah, amazing.
So that's my perfect Saturday.
Cool. So back to business.
Back to business indeed we go, yeah.
What's the biggest challenge you faced in this game and how did you get through it?
My biggest challenge, I guess the trickiest part for me was terminology. It was very hard to understand it quickly. I'll give you an example. Imagine a PM, portfolio manager, talks to his broker, to their broker, right? And goes like, all right, we're long 32 million in this index, for example. So we want to reduce the left tail exposure. We don't want to cut delta into CPI, but we are very conservative. We're very conservative, and we would like to construct this sort of defensive collar based on the put-call parity. That's a lot of information to comprehend, but it all makes sense. And the broker goes on saying that, okay, what we could do, you can long a 5% OTM put, and then short 10% OTM call option. And thus you'll construct a defensive collar via holding a long position in the asset, underwriting the call option, and purchasing, longing the put option. So you have to understand the terminology very quickly, otherwise you'll be replaced. It was very, very, very hard for me when I first got into this to understand what they were talking about. For example, the collar is a sort of a defensive hedging strategy. When you have a long exposure, long position in an asset, so you hold an asset, an index, and then you short or underwrite the call option, so you are an option underwriter, option writer, so you'll have to provide the asset in the future if the option holder requires it, and you longing, so you're purchasing the put option, so you becoming an option holder. And because obviously you receive a premium for writing an option, you receive a premium for writing a call option, and you can use this premium, right, to purchase, to long a put option. So this is called a no-cost collar. It can also be mentioned. So you have to bear that in mind. You have to be aware of all of the different things, and you have to sort of understand when if you're talking about option pricing, my favorite this is my sort of industry. I love option pricing. I do black skulls all the time. For European style options, I value American style options via the binomial trees or different Bloomberg, because I know how to do it. So now I use Bloomberg for option pricing. So you have to understand what OTM is, or ATM, or in the money. So it's out of the money, at the money, in the money options. So they all differ. And then, for example, at the money options or out of the money options, they are less expensive than in the money options, obviously. You pay less premium for those. So you have to bear that in mind and understand whether the trade is profitable or not based on the information provided. And the terminology is very tricky. For example, this bit I've just told you, it's quite tricky. So obviously you have to think very quickly in this industry. Otherwise, you'll be replaced.
So moving to the next one. What financial performance metrics a portfolio manager should be focusing on?
Right, this is a good one actually, because a lot of portfolio managers, PMs, they just focus on the yields they have, year-to-date return, and they neglect all other parameters, but there are quite a few important ones. For example, we have alpha or Sharpe ratio that pretty much mean the same thing. So they sort of measure how risky your return was comparing to the risk you've undertaken. So obviously, if you get a 40% return, but your standard deviation or variance is a volatility measure. So it sort of measures how volatile your return could have been. It's either up or down. So for example, your standard deviation was 30%, which is quite large. Although it doesn't necessarily mean that your 40% return is better than my, say, 20% return with much lower standard deviation. So I took less risk to achieve this return. And obviously, it doesn't necessarily mean that you performed better despite having a higher yield because my return was more market based. And then we can go into sort of similar topic called, it is based on beta and correlation. So the thing I want to talk about is called synchronicity. It's not a quantitative metric. It's sort of a explanatory thing. Correlation is quantitative. So synchronicity measures how closely your positions, your assets move together. So obviously synchronicity explains the aspect of total risk of your return, which consists of non-systematic risk, firm-specific risk. So we want the firm-specific risk to be high, because when synchronicity is high, right, the firm-specific risk is low. Thus, your return is being explained by systematic risk mainly. So sort of when synchronicity is high, correlation is also high. So, stocks move together pretty much, and thus we're not taking into account any firm-specific risk. So we say that the higher the firm-specific risk in your return, the more suitable your current return is for forecasting future returns, because you sort of build this return based on the firm-specific risk rather than systematic risk overall. So synchronicity is a very important measure that's being neglected by different portfolio managers, as well as alpha or Sharpe ratio that I talked about earlier, that measure how volatile and how risky your return is. And most of the time, especially during these volatile times, these metrics are quite low. So PMs used to, sort of conceal them, where they shouldn't. Risk return is very important. So that's probably three of the main factors I can think of right now.
Can you walk me through the investment approach and how you use Bloomberg to support it?
Yeah, so I do my personal investment via British ISA. This is individual savings account for British residents, which is sort of a legal tax avoidance scheme. You don't have to pay any tax on the first £20,000 you deposit each year. So it's incremental. So it goes up to £20,000 each year. So that's what I started with. So I yielded a 14.6% return for the last year. And just bear in mind that right now, this is not the best time for a portfolio. Obviously, it is a very volatile in market, and it is definitely not the best return I've ever gotten. So obviously, given the market risks and all the volatility, geopolitics that's going on right now, it is a decent return. And my Sharpe ratio was 1.34, which is also decent, meaning that I didn't take as much risk to yield my 14.6 return. As a matter of fact, it is a very nice Sharpe ratio, very low for this return in these markets for equity, as well as Sortino ratio. Sortino ratio measures negative volatility. So this is the same thing as Sharpe ratio, which measures standard deviation. Standard deviation goes both ways, up or down, while Sortino just measures on the negative surprises in economics. So on a negative volatility, because obviously if your portfolio goes up due to some different news in economy, you obviously don't care about it. So Sortino measures just the downside volatility, which is a very nice measure. I talked about it before, about the best indicators for PMs to use, as well as you don't have to forget about different regressions you can run on your returns, and that's what I do with Bloomberg. So I use different portfolio analysis metrics to run regressions and extract the R square. This is a very, very, very important statistical measure. Sort of, it helps you to understand how so this is quant, and I talked about already in the best performance indicators for PMs before, and one important thing I use Bloomberg for my analysis is running regressions on my portfolios. So obviously I use a lot of different portfolio analysis functions in Bloomberg. And then what I do, I derive an R-square measure, which is a statistical measure that shows the proportion of your return that is explained by the market. So obviously, the higher the R-square, the better the return is, because it is more explained. So it's more sort of based on information and data indeed. So obviously it is a better prediction for future as well, because I do a lot of forecasting as well, and R-square helps to measure how sort of credible your return is for future. Right, so this is a sort of it also very closely connected to synchronicity I talked about before. Also, I use Bloomberg to derive a lot of metrics for my financial analysis. I do not use Kenneth French website to get these metrics. For example, risk-free return in the market risk, or risk premium. I obviously use different functions in Bloomberg. For example, G-spread, or any other functions. I cannot recall the name of them, but obviously I got them saved and I use it for deriving the return itself, as well as pricing bonds and options. I use Bloomberg calculators to price an option, to find ETM, and all sort of other things. Obviously, it is for data collection and data analysis, because it is very easy and very user friendly. It's very convenient for you to use Bloomberg for your financial analysis instead of just computing it all in Excel, which I can.
What's the hardest lesson the market has taught you personally?
This lesson, well, I guess the risk-return sort of relationship is the most important part in the market, because before I was chasing the numbers. So obviously I was hoping to maximize my value, maximize my return, maximize my yield, and I didn't care about different risk performance metrics. And obviously I was heavily invested in different high-tech growth stocks before, so my yield was quite high. Although after tariffs last April, I lost almost 40% of my portfolio, which was very frustrating. So it was sort of a lesson I learned about diversification and risk return measurement, and now I take it more seriously. So I would like to implement different, more complicated analysis in terms of my portfolio. For example, variance covariance matrix or value at risk, to run these simulations, for example, Monte Carlo simulations or other simulations, to measure possible future outcomes of my portfolio, which my portfolio currently lacks. So some quantitative analysis is very important. So I wish I knew that caring about the risk is more important than just caring about your return, because it has to be balanced. It's not about maximizing one side. You have to sort of find the equilibrium between those two sides, and you have to maximize return to the extent that your risk is quite low. So I wish I knew it from the start. It's a good comparison. So if you're just blindly following trends, social media news, just purchasing different stocks, stuff like that, it's no different to a gamble. But when you implement quantitative analysis, which I do, and I'm starting to do it personally as well, not in terms of my sort of corporate life, but I want to do it. I want to do the same for my personal portfolio, right? And when you start doing it, your gamble becomes an educated guess, because none of the models, they can just certainly predict future. Even the Monte Carlo and other simulations. So even all of these quant firms like Citadel that look for imperfections in the market, they're not 100% certain, but they're much more educated when it comes to guessing and picking stocks, because they do have a lot of quantitative and mathematical background and research of these stocks. So they're much more the much more likely to find better options and better sort of stocks to purchase than retail investors who just blindly follow trends, I guess.
What's your go-to coffee place in London?
My go-to place for coffee? Oh, you caught me unawares. In London, I guess I would go for... Right, if we're talking about a lunch break, I would go for Roslyn Coffee in next to Bank. I guess that's my favorite place. Although I'm not a big fan of different places in my affair or
How you dress, how you carry yourself, how you show up, how much does that actually matter in the rooms you're actually trying to get into?
right. This is a very good one actually, and I would argue that people from finance, we dress better than everybody else. Apart from lawyers, perhaps, because lawyers, they wear suits all the time. But we wear these sort of casual suits, right? I know. And I guess the finance-related people are always the best looking ones. No offense, guys. I am into finance as well, and I'm pretty good looking, I guess. Am I? It wasn't the answer, right? So my point is, it is very important how you dress and how you position yourself, because it is obviously a corporate life. So there are certain expectations and thresholds for you to achieve to be there. So obviously, if you dress smart casual, sort of even, you can be viewed as an intelligent and, devoted person. So if we're talking about different deals, mergers and acquisitions, different sort of international transactions or different, sort of communications with clients, obviously you want to position yourself as a high earning individual who is educated and knows the drill, just to sort of pursue your confidence. Right? So obviously it is very important to dress nicely. And I do
So where are you trying to be in 10 years? And what's the actual plan to get there?
trying to be in 10 years. Well, hopefully not dead. Right. Jokes aside, I would like to open my personal hedge fund. And that's what I'm starting this September. I'm registering my personal investment company in London. It is going to be sort of a personal investment fund, a closed one, because I haven't got license yet for investing others' money. I'm not certified for that, but I would very much like to receive them one day. And obviously, having a hedge fund suits my goals and ambitions, and I would like to grow it further. Because I am into investments. I am about finance. I am about investments. I am about these things, and obviously, I would like to have some schemes to avoid taxes as well. So obviously, yeah. Well, hedge fund is my ultimate goal, and obviously, I want to be in Forbes by 30, hopefully. Yeah, 30 under 30. That's my ultimate goal. Yeah, I guess I've got this ambition. I know it might sound ambitious, but that's what I'm walking for.
At what point did you stop thinking about making money and start thinking about building something that outlasts you, or legacy?
This game was never about money for me. I am pretty well off as of now, and I'm pretty much, satisfied in terms of financial things, right? But it's more about some aspirational things. Think about it, like we'll have our children one day, right? And then they'll have their children. So you'll be a grandfather at one point, and your name will be remembered. But then their children after them, they might not remember you. So your name will be forgotten. And you'll be forgotten overall. It is very depressing, I know, but that's a fact, and you have to understand it. So what I want to do is I want to sort of contribute to this society somehow, for my name to be remembered in the future. It can't be a company that outlasts me, or a company that does something good for society, or I love teaching, to be honest. I'm not a teacher. I haven't got a PhD yet, but I feel like I enjoy sort of, explaining things to others, especially about finance, because I know a lot. My academic background is vast, and I know a lot about finance. So when people ask me some basic questions or some more complicated ones, I enjoy answering them, and I feel like I enjoy academia overall. Maybe I'll be the next Miller and Modigliani, who's gonna invent a new theory, like Miller theories, right? So I would like to leave a sort of something after me, but most likely it's going to be a large hedge fund, hopefully. So yeah, it's more aspirational. It was never for the money.
Yeah.
I'm not too bothered. Like I feel like life is much larger than just receiving a high income. For example, you probably don't know, but I'm really into philosophy. In my free time, I'm listening to Alex O'Connor. It's my favorite YouTube blogger who talks about our place in this world, the understanding of philosophy overall, the God, stuff like that, our social aspects, and different things like this. So I am absolutely fascinated by his thoughts, and I like to think about it myself. And globally, what you do now, sort of normal life, doesn't matter. So I want to have this different sort of scale of importance. I would like to contribute so I can't be remembered, and I actually want to do something good for society or maximize shareholder value. That's right. That's about it.
What does BELLUMAIRE mean to you?
Quiet success. If I were to describe it in 2 words, I would say quiet success or good quality or future success as well. That's about it. And I like it. I like it very much.
Oh, amazing. Thank you.
Well, thank you very much. Thanks for having me. And thank you for the quarter zip, mate. This is one of the best ones I've ever had.
Thank you for joining us here, and we appreciate you. Thank you for your time.
Thank you for having me.